Good morning and welcome to 3 Minutes on Markets and Money. Picking up pennies in front of a steamroller. That's the name of our article today on the website. And the reason I bring this up is because I got a tweet here recently asking, hey, I'll read your newsletter, but I really don't understand how you can be buying into this market, when all this stuff is going on. And that's a really good question because this is the differential between understanding short-term market environments versus long-term valuations. Yes, we spend a lot of time talking about long-term valuations. Price to sales at 3 times. That suggests that forward returns on markets are going to be less than zero over the next decade. So why on earth would you buy into the markets now? Well, the reason is we've got to make money now. Right? We've got goals to reach in terms of our financial plans. We've got investment goals we've got to reach. We've got things we got to fund. So we have to take advantage of opportunities in the markets when they exist, but also understand that we have to manage the risk of those investments as well. Look, if I choose just to use valuations as a measure to get in and out of the market, I would have been out of the market since 2000. And I would have missed 2 very strong bull markets during that time frame. Yes, I would have missed the 2 bear markets, but I would have missed all the advances that I could have made in portfolios as well during that same time frame. So this is why technical analysis is very useful in terms of helping to mitigate risk in portfolios and to manage exposure over time. So again, when we talk about technical analysis, it's not an all in or all out. We're not saying be all in, all out of the market here, be all back into the market here. You cannot time the markets that way. We treat investing very much like a garden, which is basically weeding and pruning, harvesting the crops, trimming out the weeds, making sure that there's water and fertilizer, and growing a healthy portfolio over time requires maintenance. And that's all we're talking about here. And starting about 5 weeks ago, we started talking about this money flow sell signal. We said, hey, look, when you get a sell signal here with positive money flows, generally the markets don't do a whole lot. They just kind of go sideways. We reduced exposure some in our portfolios, rebalanced some of our risk. And then starting about 2 weeks ago, we were a little early as the markets kind of started touching support here. We started adding exposure to portfolios back here. And that's worked out okay here because we've been waiting for this money flow buy signal to occur, which has now happened. That gives us the potential here for the markets to rally back here to all-time highs, maybe even set a new high in the short term. Don't expect here a lot of upside for a variety of reasons, particularly as we move further into summer. Really don't expect a lot of upside here. We're going to move very quickly through this buy signal over the course of the next couple of weeks, and then very likely we'll see a bigger correction sometime this summer. So at that point, we'll begin to reduce risk again as this signal begins to tell us that, hey, this is we're now back to the point markets are overbought, time to reduce some risk, time to raise some cash in portfolios. Again, not an all in or all out, just simply managing risk around the edges, controlling returns over time. Yes, are you going to give up some of the upside? Absolutely, but you're not going to absorb as much of the downside. And that's the key to winning the long-term investing game. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.